Let's start with the big picture. When you operate as a company, the money in that company doesn't actually belong to you personally. It belongs to the business. Before Division 7A existed, some people used to take money out of their companies for personal use without declaring it properly. That meant they were enjoying company profits but not paying the full amount of personal tax that they should have been. So the government introduced Division 7A to stop that from happening. It ensures that when company funds end up in a shareholder's hands, they're taxed appropriately, whether or not they're formally declared as dividends. So what is Division 7A and how does it work? Division 7A is part of the Income Tax Assessment Act of 1936 and is an anti-avoidance provision that prevents private companies from distributing profits to shareholders or their associates as tax-free payments, loans, or forgiven debts. Here's how it works in practice. When money moves from a company to a shareholder or associate, it needs to be properly classified as one of three things. Firstly, a salary or a wage, which goes through normal payroll and gets taxed as normal income. The second way is a dividend, which is declared and taxed through your personal returns. Or the third way is a loan, which must have proper documentation and repayment terms matching the benchmark rates. If you take the money out and it doesn't fall into one of those categories, Division 7A can step in. The ATO may treat this payment as a deemed dividend, meaning it's taxed at your personal income. And it's likely that it'll be deemed as an unfranked dividend, meaning any imputation credits or franking credits you've received from paying tax within the company won't come along with that dividend that the ATO has deemed to you. In other words, if it looks and acts like a personal benefit, the ATO can treat it like one. So why does it matter? For business owners, this is about more than just avoiding penalties. It's about managing your finances properly, keeping clear boundaries between business and personal money, and avoiding unnecessary tax surprises at the end of the year. When Division 7A applies, it can create extra tax liabilities and compliance issues, which can be avoided with the right planning and documentation. How to stay compliant. The good news is, staying compliant is straightforward. Keep your company and your personal finances separate. Record all payments and loans clearly, and work with your accountant to ensure any distributions are correctly classified. By doing that, you'll avoid Division 7A headaches and keep your company structure working as it should. At Lawpath, we help business owners understand how tax and legal rules like the Division 7A affect their day-to-day operation. If you're paying yourself from your company, make sure you're doing it the right way, because when it comes to tax compliance, it's always better to plan ahead, not clean up after.